This is Alan Bush with ADMIS with the Daily Financial Forecast for Thursday, November 5th. Starting out with the stock index futures, yesterday we did see some pressure developing this after Janet Yellen, Fed chair, indicating that the Fed appears to be on track to possibly raise interest rates at their December meeting. However, today we're seeing higher prices, this with overseas equity markets trading mostly higher. So that's supporting U.S. stock index futures today. Also, we do believe that longer term we will see new historical highs for all of the major indices, and I think that will take place next year. And it was just several days ago, in fact last week, that the NASDAQ futures made a very substantial high for its move. So nothing really changing in our long-term view. We continue to believe that the global economy will be supported by additional economic stimulus from many of the world's major central banks, and that will propel stock index futures higher. So look for higher today, higher longer term, and higher into next year. Now moving over to the foreign currencies, we are seeing the euro currency holding up relatively well, even though we did have German factory orders showing a decline when an increase had been expected. The big mover today, however, is the British pound, as much as 150 points lower. This after the Bank of England at their policy meeting indicating that in their estimation, growth for this year and next year will be less than what they had predicted earlier this year. This also does appear to delay a rate increase from the Bank of England now out to sometime in 2017. Our feeling remains that the Bank of England will be very hard pressed to raise interest rates at all, which is our feeling for the Fed, which we'll get into in a bit. So the dollar index trading a little bit better today. Some follow-through gains from yesterday after Yellen's hawkish comments. However, we do feel that the Fed seems to like to talk about raising interest rates, talking about the economy being better, and yet when it comes down to it, to the actual meetings, it seems that they just cannot pull the trigger, and I don't think they have reason enough to raise interest rates this year or next year as well. So as far as the interest rate markets now, seeing the long end a little bit lower. It looks like some of this hawkish talk from Yellen a bit of a negative. But we do feel, as we said, that the Fed will not be raising rates anytime soon in spite of hawkish comments from a variety of Fed officials. So longer term, we do believe the trend is still higher for the 30-year bonds. It will not be a straight-up move. It'll be a bit more of a slow advance, but with all the central bank accommodation that we are anticipating, that should support the long end extremely well. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.